happened fast. $83, then $82, then $75. In less than an hour, billions vanished. Charts broke, support cracked, and most people didn't even see it coming. But here's the part. Nobody's talking about this drop didn't start at $75. It started days earlier, on a level most traders ignored. And now, with CPI hours away and global markets already shaken, the real question isn't why silver fell. The real question is what was positioned before the fall and what might be positioned right now, because the next 24 hours could change everything. Welcome to Market Metal, where we break down economic reality calmly, clearly, and without hype. If you've been through a few market cycles, maybe 2000, maybe 2008, maybe the volatility of recent years, then you already know how quickly sentiment can flip. So before we continue, I'd humbly ask you, if this channel helps you think more clearly about your capital, consider subscribing. Think of it like joining a quiet discussion group where experience matters more than noise. And tell me in the comments, where are you watching from today? The breakdown, what actually happened. Silver did not drift lower. It moved with speed and force. The price was trading between $82 and $83. Within a short window, it fell to $75. That is nearly a 10% drop. For most casual observers, it looked sudden. For experienced market participants, it looked like a structure finally giving way. He began by reconstructing the timeline. In the hour before the decline, silver had already failed to reclaim an important technical level, the 150-hour exponential moving average. In simple terms, the moving average often acts as a line of resistance when price is weak. When price stays below it and repeatedly fails to break above it, the structure is vulnerable. It signals that sellers are still in control. Silver had attempted to move higher earlier in the session. Each attempt was rejected near that moving average. Buyers stepped in, but they did not have enough strength. Volume did not confirm the move. When price cannot move above resistance, pressure builds beneath it. Traders who bought too high begin to feel exposed. Stop-loss orders accumulate under support levels. The market becomes fragile. Then the break came. As price slipped below $80, selling accelerated. When it broke below $78, stop-loss orders triggered in clusters. Algorithms reacted. Short-term traders exited quickly. Within minutes, silver printed $75. The move was not gradual. It cascaded. At the same time, other markets showed stress. Gold declined more than 3%. Equity indices, such as the S&P 500 and NASDAQ, moved lower. Crypto markets also fell. Reports estimated that approximately $3.6 trillion in global market value was erased in a short window of time. This was not a move isolated to one asset. It reflected broader risk reduction. However, silver's decline was sharper than most. That is typical. Silver is historically more volatile than gold. It reacts faster and more violently to shifts in liquidity and sentiment. When markets reduce exposure, silver often absorbs a larger percentage move. The question serious decision makers must ask is not whether silver fell. The question is why it fell at that moment. One factor was positioning ahead of economic data. The Consumer Price Index report was scheduled for release the next day. Inflation data can shift expectations about interest rates, currency strength, and policy direction. Traders often adjust positions before such reports. Some hedge risk, some speculate. When positioning becomes one-sided, even small imbalances can trigger outsized moves. Another factor was technical structure. The 150-hour moving average had acted as resistance for days. Price did not reclaim it with conviction. Each attempt to move above it was rejected. That repeated failure weakened confidence among short-term traders. When support failed, many had little reason to hold. A third element was ETF mechanics. The largest silver exchange traded fund, SLV, began trading at a discount to its net asset value. In simple language, that means the shares were priced lower than the value of the silver they represented. When this happens, authorized participants, large financial institutions, can buy the ETF shares at a discount and redeem them for physical silver. This process is legal arbitrage. It is part of how ETFs function. When shares trade at a discount, institutions may redeem them, remove physical metal from the ETF, and use that metal to settle other obligations. This does not require public announcements. It occurs through established mechanisms. The effect can increase pressure on paper pricing, even if physical demand remains steady. At the same time, a calendar event added complexity. The Shanghai Metals Exchange was scheduled to close for the Chinese New Year holiday from February 15th through February 23. During this period, Eastern physical participation reduces significantly. With fewer buyers active in Shanghai, Western paper markets can exert greater influence on short-term price discovery. Historically, some periods of lower Asian participation have coincided with higher volatility in Western trading hours. Reduced liquidity can amplify moves. When a major physical market is temporarily quiet, paper markets often dominate pricing. Yet, an interesting divergence appeared. While Western spot silver traded near 70 spot dollars, Shanghai prices reflected a premium of roughly $7. In other words, physical silver in the East commanded a higher price than paper silver in the West. This does not automatically signal a shortage. However, it does show regional differences in demand and pricing pressure. Such divergences matter to business leaders and entrepreneurs because they reflect underlying supply chain realities. Silver is not only an investment asset, it is a critical industrial metal used in electronics, solar panels, and advanced technologies. When physical premiums widen in major consuming regions, it suggests continued demand from manufacturers and strategic buyers. COMEX registered inventory also remained below 100 million ounces. Meanwhile, open interest for the March contract represented claims on approximately 325 million ounces. Not all contracts stand for delivery. Many are rolled forward. However, the ratio between paper claims and registered metal remains a key metric to monitor. It reflects potential stress if delivery demand increases. Short-term traders focus on price. Strategic operators focus on structure. From a purely technical perspective, $74 now becomes a key level. If that support holds, price could stabilize and potentially form a base. Some analysts would watch for an inverse head and shoulders pattern, a common reversal structure. But if $74 fails decisively, a retest of prior lows near $64 becomes possible. He does not frame this as prediction. He frames it as conditional logic. Markets respond to levels. Levels either hold or break. It is also important to zoom out. Over the past 6 months, gold has risen significantly, and silver has participated in that broader trend. A sharp correction within a larger uptrend is not unusual. Volatility does not automatically invalidate structural deficits or long-term demand drivers. Data from industry sources continues to indicate a multi-year supply deficit in silver. India has been importing a large portion of global mine supply. Industrial demand remains strong. These fundamentals did not change in 90 minutes. What changed was sentiment and positioning. For serious decision makers, the lesson is not to react emotionally. It is to observe the sequence. First, resistance held. Second, support broke. Third, stop-loss cascades accelerated. Fourth, liquidity conditions amplified the move. Fifth, divergence between paper and physical pricing widened. Each step can be verified using public data. None requires speculation. As CPI approaches, markets will reveal whether the sell-off represented defensive positioning or a broader shift in narrative. If inflation data surprises to the upside and metals rally, it may suggest pre-positioning ahead of the release. If metals continue lower despite strong data, it may signal deeper risk-off conditions. In the end, part one is not about drama. It is about mechanics. Silver did not fall in isolation. It fell at a technical resistance level ahead of major data during a calendar window of reduced Eastern liquidity, with ETF discounts widening and cross-asset liquidation underway. Those who understand structure are not surprised by volatility. They prepare for it. The next question is not what happened. The next question is whether this was a temporary flush of weak positioning, or the beginning of a more significant shift in the balance between paper markets and physical demand. Paper versus physical, a market divergence. When the dust from the initial drop began to settle, a more important story quietly emerged beneath the surface. Silver in the West was trading near $75. Yet in Shanghai, physical silver was still commanding roughly $82 spot and $85 in futures. That represented a premium of about $7 over Western paper pricing. To the casual observer, this might appear as a minor regional price difference. To a serious market operator, it represents something deeper. It suggests that price discovery is not unified. It suggests that the paper market and the physical market are not moving in perfect alignment. He began by examining the structure of this divergence. In Western markets, the majority of price action occurs through futures contracts and exchange-traded funds. These instruments allow traders to gain exposure to silver without taking delivery. Liquidity is deep. Leverage is available. Positions can be entered and exited within seconds. In Shanghai, however, participation is more closely tied to physical flows. Industrial buyers, refiners, and wholesalers operate within a different framework. When physical premiums expand there, it often reflects real demand rather than speculative positioning. The widening premium during a Western price collapse sends a clear signal. Physical buyers were not retreating at the same pace as paper sellers. This is not proof of shortage. It is evidence of separation. COMEX data adds another layer. Registered silver inventory remained below 100 million ounces. At the same time, March open interest stood near 65,000 contracts, equivalent to approximately 325 million ounces of paper claims. Not all of those contracts will stand for delivery. Many will roll forward to May. That is standard practice. Yet ratios matter. When open interest is more than 3 times the size of registered inventory, the system depends on participants choosing to settle in cash or roll their positions. It functions smoothly as long as confidence remains intact. Stress begins when a higher than expected percentage requests delivery. February had already shown elevated delivery activity relative to open interest. If similar behavior carries into March, the exchange faces a visible stress test. He does not frame this as a prediction of failure. Exchanges have mechanisms to manage liquidity, contracts can roll, cash settlement is allowed, margin requirements can be adjusted. These are part of normal market operation, but the ratio remains a fact. Then there is backwardation. Before the holiday closure, segments of the Chinese futures curve showed signs of backwardation, where near-term contracts trade above longer-dated ones. In commodity markets, backwardation can signal short-term tightness. It does not guarantee shortage, but it indicates urgency in near-term demand. When backwardation appears alongside a widening regional premium, decision-makers take note. The structural backdrop reinforces the tension. According to industry data, silver has recorded multiple consecutive years of supply deficit. Industrial demand, from solar panels, electronics, and advanced manufacturing, continues to expand. India alone has been importing roughly a quarter of global mine supply. That is not marginal participation. It is structural absorption. These fundamentals did not reverse during the 90-minute price collapse. So why did price fall? Because paper markets can move faster than physical flows. Futures traders react to technical levels, algorithms respond to volatility, funds manage risk across portfolios. When liquidity tightens, assets are sold. Physical demand, by contrast, operates on procurement cycles and manufacturing schedules. A factory does not cancel orders because price drops 8% in one session. It may even accelerate purchases if lower prices improve margins. This difference in speed creates opportunity and tension. If the Shanghai premium continues to widen while Western futures remain pressured, arbitrage eventually attracts attention. Capital seeks imbalance. However, capital controls, logistics, and transaction costs limit immediate convergence. Markets can remain divergent longer than expected. Meanwhile, the SLV discount to net asset value persists as another pressure point. When the ETF trades below NAV, authorized participants can redeem shares and extract physical silver. This mechanism can remove metal from the fund while maintaining downward pressure on the paper price. Again, this is not a conspiracy. It is a structural feature of ETF design, but in periods of stress, such features amplify moves. The approaching March 1st notice day adds urgency. February 27th marks the point at which traders must declare delivery intentions or roll forward. As that date nears, positioning becomes more deliberate. Shorts assess their exposure. Longs decide whether to stand for delivery. Volatility often increases. He presents two measured scenarios. In the first scenario, most contracts roll forward. Delivery remains manageable. Premiums narrow as liquidity returns after the holiday. Price stabilizes above $74 and begins to rebuild structure. In the second scenario, delivery interest remains elevated. Registered inventory continues to decline. Premiums widen further. Futures volatility increases as participants reassess counterparty risk. Neither scenario requires alarmist language. Both are plausible outcomes within a functioning market system. For business leaders and entrepreneurs, the relevance extends beyond trading profits. Silver sits within supply chains critical to renewable energy, semiconductors, and high-efficiency electronics. When pricing signals fracture between regions, procurement strategies may require adjustment. A manufacturer planning expansion must ask, is this dip a temporary liquidity event, or does it reflect deeper stress in the pricing mechanism? Investors managing capital must ask, does volatility signal weakness, or is it a shakeout within a structural deficit cycle? What makes this moment unique is the combination of elements: technical breakdown, ETF discount mechanics, holiday liquidity vacuum, CPI uncertainty, widening physical premium, and elevated open interest ratios. Each factor alone is manageable. Together, they create a narrow window where the balance between paper leverage and physical demand becomes visible. Markets rarely announce structural shifts in advance. They reveal them through divergence. The premium in Shanghai is not a headline. The open interest ratio is not emotional. The inventory level is not dramatic. Yet collectively, they form a pattern. The question now is whether that pattern resolves quietly or accelerates as March approaches. In financial systems, stress does not begin with panic. It begins with small imbalances that widen. And in this case, the imbalance between paper selling in the West and steady physical demand in the East may be the signal that deserves the closest attention. Systemic context: when liquidity tightens, everything moves. The silver chart did not exist in isolation. While traders focused on the drop from $83 to $75, something larger unfolded across global markets. In roughly 90 minutes, an estimated $3.6 trillion in market value disappeared across equities, metals, and digital assets. Gold declined. The S&P 500 moved lower. The Nasdaq fell more sharply. Crypto markets weakened. This was not a single asset event. It was a liquidity event. He begins with a simple principle. When liquidity tightens, correlations rise. Assets that normally move independently begin to fall together, not because their fundamentals suddenly changed, but because capital is being withdrawn at the same time. Silver is particularly sensitive during such moments. It carries both industrial and monetary characteristics. It is traded heavily by funds using leverage. When margin pressure builds elsewhere in portfolios, silver often becomes a source of liquidity. It is sold not because it is weak, but because it is liquid. This is where most investors misunderstand volatility. They assume price equals value. In short windows, price reflects positioning. The CPI report, scheduled for release the next day, added another layer of uncertainty. Inflation data influences expectations about interest rates, real yields, and currency strength. When inflation runs hot, central banks tend to maintain tighter policy. When inflation cools, policy easing becomes more likely. Metals respond to both narratives, but in different ways. Before major data releases, professional funds often reduce exposure. They do not wait for confirmation. They manage risk in advance. That process can trigger pre-positioning, and when pre-positioning becomes crowded, even small technical breaks can accelerate into cascades. The timing is important. The decline occurred one day before CPI. It occurred as the Shanghai exchange prepared to close for holiday. It occurred while the 150-hour moving average remained overhead resistance. It occurred while ETF discounts widened. This convergence is not coincidence. It reflects the stacking of risk variables. He does not frame it as hidden coordination. He frames it as systemic behavior. Markets operate through feedback loops. When volatility rises, algorithms increase selling. When selling increases, volatility expands. When volatility expands, margin calls appear. When margin calls appear, forced liquidation spreads across asset classes. That chain reaction is mechanical, not emotional. Silver's nearly 8 to 10% intraday movement fits historical patterns during stress episodes. In prior cycles, 2008, 2011, 2020, silver displayed amplified swings compared to gold. It is a thinner market. It reacts faster. But what makes this episode different is the structural backdrop. Industry data indicates silver has recorded multiple consecutive years of supply deficit. Demand from solar panel manufacturing, electronics, and energy infrastructure remains elevated. India continues to absorb a significant portion of global mine supply. These trends do not disappear in a single session. Therefore, the decline presents a paradox. If fundamentals remain firm, why does price fall so sharply? Because short-term price is not determined by mine output or fabrication demand. It is determined by futures positioning, dollar strength, real yield expectations, and portfolio liquidity needs. The US dollar index strengthened during the session. Real yields moved. Risk appetite declined. In such an environment, metals often face immediate pressure. Even long-term bulls reduce exposure temporarily to manage drawdowns. Professional investors understand this cycle. They do not interpret every decline as a change in thesis. They assess whether the decline alters structural assumptions. He outlines two macro interpretations. The first interpretation is pre-positioning ahead of inflation data. If CPI were to come in stronger than expected and metals rally afterward, the decline would appear as accumulation at lower levels. In that case, the drop would represent strategic repositioning rather than systemic weakness. The second interpretation is a broader risk-off environment driven by tightening financial conditions. If CPI were to reinforce deflationary concerns or strengthen the dollar further, metals could remain under pressure. In that case, the decline would align with macro contraction. Both interpretations are rational, neither requires dramatic language, yet there is a deeper systemic element at play: leverage. Modern markets are layered with derivatives. Futures contracts, options, swaps, and ETF structures allow exposure far beyond physical supply. When open interest in a contract represents multiple times the underlying registered inventory, confidence becomes a central pillar. As long as most participants choose to settle financially rather than physically, the system functions smoothly. Stress begins when confidence wavers. The March silver contract carries open interest equivalent to roughly 325 million ounces, while registered inventory remains below 100 million. This ratio does not predict failure. It highlights dependency on orderly behavior. If volatility shakes confidence, some participants may reconsider rolling positions. If that occurs near first notice day, volatility could increase further. This is not a forecast of crisis. It is a description of structural leverage. Entrepreneurs and business leaders should pay attention because silver pricing feeds into supply chain planning, hedging costs, and procurement timing. Volatility affects working capital. It affects margins. It affects expansion decisions. When liquidity stress intersects with commodity deficits, price swings become sharper. It returns to the broader context. Over the past 6 months, gold has appreciated significantly. Silver participated in that trend. A sharp retracement within a rising channel does not invalidate the broader structure. Markets rarely move in straight lines. The real signal is not the drop itself. It is how markets behave after the drop. If silver stabilizes above $74 and reclaims the 150-hour moving average, the decline may be remembered as a volatility flush. If it fails and drifts towards $64, it would signal deeper structural pressure. But beyond levels lies sentiment. Sentiment can change in hours. Structural supply trends change in years. The distinction matters. In systemic environments, moments of stress expose the plumbing of markets. They reveal how ETFs function. They reveal how futures roll. They reveal how premiums widen between regions. They also reveal who is reacting and who is preparing. Silver's fall from $83 to $75 was visible. The liquidity contraction across global markets was measurable. The question now is whether the system absorbs the shock quietly or whether these imbalances compound as March delivery approaches. When liquidity tightens, everything moves. The disciplined observer does not panic. He studies the pattern. Because what happens next will not depend on headlines. It will depend on structure, the decision window. What the next 30 days will reveal markets rarely announce turning points in advance. They approach them quietly through narrowing ranges and expanding tension. Silver now sits inside such a window. The fall from $83 to $75 has already occurred. The emotional reaction has already passed. What remains is structure, and structure is where decisions are made. He begins with the most immediate level, $74. If $74 holds with conviction, the chart may begin forming a base. Stabilization above that level would suggest that sellers exhausted themselves during the cascade. It would also open the possibility of an inverse head and shoulders formation, a technical reversal pattern that signals accumulation beneath visible price weakness. However, if $74 breaks decisively, the probability of a retest near $64 increases. That level represents the prior major correction zone. Markets often revisit prior liquidity pools before rebuilding momentum. A move toward $64 would not automatically invalidate the longer-term deficit thesis, but it would signal that paper leverage remains dominant in the short term. The first decision point is technical. The second is structural, March delivery. First notice day approaches on February 27th. By then, traders holding March contracts must either declare delivery intention or roll their positions forward to May. Historically, most participants roll. That is normal. But elevated delivery demand in February has placed attention on March. Open interest, near 65,000 contracts, equates to roughly 325 million ounces of silver exposure. Registered inventory remains below 100 million ounces. This ratio is manageable under orderly conditions. It becomes sensitive if delivery participation rises unexpectedly. He does not suggest failure. Exchanges have mechanisms, cash settlement, position limits, margin adjustments to ensure continuity. But stress tests reveal strength. March will function as a test of confidence. If most contracts roll smoothly, volatility may compress. If delivery participation surprises to the upside, spreads could widen and premiums may expand further. At the same time, Shanghai returns from holiday closure. Eastern participation will resume. Physical flows will become more visible. If the $7 premium persists or expands after reopening, it would signal that the divergence between paper and physical markets remains unresolved. If the premium narrows quickly, it may indicate that the Western sell-off was primarily liquidity-driven rather than supply-driven. Then there is CPI. The inflation report serves as an immediate catalyst. A hotter than expected reading could pressure equities and strengthen the dollar, initially weighing on metals. Yet, paradoxically, it could also reinforce the long-term inflation hedge narrative, inviting renewed interest. A softer CPI could weaken the dollar and support metals in the short term, but it could also revive recession fears, leading to broader risk aversion. Price reaction matters more than the number itself. Professional operators watch how markets respond to information, not the headline alone. If silver rallies strongly on data that appears neutral, it suggests positioning was defensive and now unwinding. If silver falls even on supportive data, it signals structural weakness. This is where suspense builds. The next 30 days bring overlapping variables. CPI release, Shanghai reopening. March 1st, notice day. Ongoing ETF discount dynamics. Technical support at $74. Rarely do so many factors converge at once. He presents two structured scenarios. Scenario 1, controlled stabilization. Silver holds above $74. CPI does not destabilize expectations. Shanghai premium narrows moderately but remains positive. March contracts roll smoothly. The 150-hour moving average is reclaimed. Volatility subsides. In this outcome, the drop from $83 to $75 is recorded as a sharp but temporary correction within a larger structural trend. Scenario 2, escalating stress. Silver breaks below $74 and tests lower levels. CPI reinforces dollar strength. Shanghai premium widens further upon reopening. Delivery participation increases into March. ETF redemptions persist. In this outcome, Volatility expands and liquidity thins. Confidence becomes the primary variable. Neither scenario guarantees crisis. Both require disciplined observation. For entrepreneurs and business leaders, this is not abstract theory. Silver pricing influences production costs in electronics, renewable energy, and industrial manufacturing. Volatility alters hedging decisions. It affects inventory management and capital allocation. In uncertain windows, strategic patience often outperforms reactive action. He emphasizes capital preservation, not avoidance of opportunity, but protection against impulsive decisions. When volatility accelerates, risk expands faster than perception. The broader structural context remains intact. Industry reports continue to cite multi-year supply deficits. Industrial demand trends remain firm. India's imports remain elevated. These are slow-moving forces, but short-term price is governed by liquidity, leverage, and positioning. The coming weeks will clarify which force dominates. Markets do not collapse from single events. They weaken when structure deteriorates unnoticed. Likewise, markets do not strengthen from single rallies. They strengthen when repeated tests fail to break support. Silver now stands at such a test. The 150-hour moving average remains overhead resistance. $74 remains immediate support. Shanghai's premium remains a divergent signal. March open interest remains elevated. CPI remains imminent. The disciplined observer does not predict. He monitors. If support holds and structure rebuilds, the narrative shifts toward resilience. If support fails and leverage compounds, caution intensifies. The fall from $83 to $75 was visible. The decision that follows will be quieter, but more important. In financial systems, turning points are rarely loud. They are recognized only by those who study the details, while others focus on headlines. The next 30 days will not simply determine silver's price. They will reveal whether this was a volatility event within a functioning system, or the early signal of a deeper recalibration between paper markets and physical demand. And that distinction will matter far beyond a single chart.